Good morning. It is Thursday. It is the Bubba Show. So today we haven't really, for months we stopped with jobless claims, and I think it's just something to watch out for. And I'm not going to make a big deal about it, but keep an eye on them. And keep an eye on actually more how the market reacts off of the jobless claims. But today I wanted to talk about, I see some warning signs in the market, and I wanted to discuss what they are and what to watch for. So a little bit, we touched a little bit about it yesterday on Wednesday's edition when we talked about the hawks and the doves. So, if indeed we are going to go more to a hawkish point of view, then the market is going to get some selling pressure because the flow of free funds, the way that the very wealthy have been able to borrow money, companies like Apple who've been able to leave their money overseas and then borrow money here and save that 30% tax rate, the big banks who have been able to get rid of all their toxic debt, that has been what has been driving this bullish market. But there are now also some other warning signs starting to show. The advanced decline line, which is the number of advancers versus the number of decliners every day, has started to weaken. That's a warning sign. It's not a green light to say go ahead and short the market. What it is, it's a sign telling you that there's now starting to become some underlying weakness. Now this can resolve itself over time. If the market doesn't break, it can resolve itself as the market might consolidate. Another very big warning sign to take a look at is the number of new lows being made. The number of new lows are climbing on a regular basis as well. So as you start to see new lows, that's also a sign of potential weakness in the market, that the market could be thinking about going down. But the bottom line is we've had these warning signs before, and the market has ignored them. What you have to focus on is when the technical pattern actually starts to take fold. You and I cannot dictate what the top or when a top should be in the market. The market is absolute. The market is always right. So we don't want to try to pick the top or the bottom of the market. What we want to wait for is the technical indicators. Now we've talked about today some possible warning signs that might indicate a top, but we want to wait for the chart pattern to prove to us that the market is actually going to switch directions. Right now I can't tell you that we're going to have a switch in the market. All I can tell you is that the overall tape and the trend of the market continues higher. So why do I want to try to pick the top when I can't do it? It doesn't make sense. Let the markets indicate, follow the footprints of the market, let them tell you where they want to go, and then follow along. Remember, your risk is only the amount of your stop loss. So we can afford to take some chances, but why take chances when it's a coin flip when we can wait a little bit longer and get a better chance, better odds and probabilities in our favor? So as you can see, there is no real reason yet to actually be an aggressive shorter of the market. Let's wait, let's watch the warning signs, and the market will tell us when it's ready. Let's wait for our opportunities and be in a good spot and have a much higher probability. For Thursday, the Bubba Show, we'll talk to you on Commodity Corner Friday.